In this video, we define the scope and magnitude of the current debt crisis, the impact on the global financial system, possible outcomes, and the possible investment implications for various outcomes. We'll also look at the scope of the problem in terms of why government bond defaults are likely sometime in 2012, despite what you're hearing from leaders. I recently had a conversation with a client, and the client said, Chris, I see the numbers, I understand the debt levels, but it's very difficult to understand when do those debt burdens become a problem. It's a fair question, one that's very difficult to answer for your average market participant. Kyle Bass of Heyman Capital Management in Dallas has taken a hard look at the problem and done a lot of research on it. The accepted white paper definition of when you run into a problem is when your government debt levels and the size of your banking system, so if you take these two numbers and add them together, when they get to a point where the sum of them is greater than 5 times your government revenue, that's when you run into problems. Why is that? Well, when the banking system gets extremely large and the debt burden gets extremely large, if the government has to bail out the banking system, the scope of the problem relative to your revenues, it just becomes too big and overwhelming. Let's look at the current state of the world. 5 times government revenue relative to these two numbers is when you start to run into problems. These numbers here tell us that we've got problems that are going to be difficult to address. Ireland was one of the first countries to run into problems. We know Spain, Portugal have run into problems as well. And now we're hearing rumblings about France and Germany. Greece has gone down. Italy has moved towards the forefront in terms of potential problems. A fair question would be, why is Italy in the news and why are their bond yields spiking when it seems that they're in better shape than Germany? Well, as we'll show in some flowcharts, it really has to do with the health of the German economy and balance of payments. The German economy is much more efficient and healthy than Italy's economy right now. What a current account is, it's your balance of payments. So think of it as your net imports versus exports, basically the net of the two. And what you see here is Germany is exporting more goods than they're importing. And why is that important? When you're running a current account surplus and you're above the zero line, it means that foreign capital is flowing into your economy. And as we'll show later, some of that money ends up in the banking system, and it makes it easier for Germany to service their debt levels. Contrast that with Italy, who's running a current account deficit, which means their economy is not nearly as healthy or efficient as the German economy, and thus it makes it more difficult, especially longer term, for them to service their debt. It also means that instead of foreign capital flowing into the country, you've really got money flowing out of the country, which again exacerbates your problem in terms of servicing debt levels. Portugal, similar problem, running a deficit. Spain, running a deficit. Greece, running a deficit. So for all these countries, to try to grow your way out of it is difficult. If Europe were to go into a recession, and most people believe that's where we're headed, it becomes more and more difficult to service the debt that they have. Japan, who is not in the news currently, but was high on that list in terms of potential problems, still runs a current account surplus, which means foreign capital is flowing into the Japanese economy. The concern longer term, as cited by Kyle Bass, is that their current account is shrinking. The smaller this gets, and as this trend line goes down, longer term, it's going to be very, very difficult for Japan to deal with this imbalance here, which would be, if you add up their government debt plus the size of their banking system, 37 times is greater than 5 times, which says potentially you have a problem. Another thing that's important for all of us as investors is we obviously need to take the messages that are being delivered from government leaders with a grain of salt. And let's look at a historical example. If you remember the 1994 tequila crisis, Mexico was persistently saying, we're not going to default on our debt, we're not going to devalue our currency. In fact, they made that statement one day, and the next day, they devalued their currency. History tells us that while Mexico was saying we will not devalue, we will not default, they had already 10 days earlier met with business leaders and tried to get feedback on what's going to happen when we devalue. Had they, during that 10-day period, not answered the questions in this manner, then you would have had an uncontrolled situation that they didn't want. So if you're a European leader right now, even if you believe that there's going to be restructurings or devaluations or someone's going to leave the euro, you can't tip your hand because the markets will get ahead of you. So we have to take, again, with a grain of salt, the statements that we get out of any country or from any leader, because they can't tell you, yes, we're planning on defaulting, yes, we're planning on breaking up the euro. They're trying to get this thing under control as best they can, and they want to manage when that default or partial default comes or when someone's going to leave the euro. If we fast forward to the present situation, in January of this year, Greece was saying we're not going to default. We're going to meet all of our payment obligations. It's not our roadmap. That's not where we're going. And as we all know now, Greece, as I speak, is currently working with creditors to wipe out 50% of their debt obligations. They can call it a voluntary restructuring. The reality is that's a form of a default, even though we heard from European leaders that for a long time that no one's going to default. Now we're going to take a more detailed look at the problems that we currently have. And the three main players in the financial markets are central banks, so think the Federal Reserve in the United States, or the European Central Bank, or ECB in Europe. Then you've got your large financial institutions like Bank of America, Goldman Sachs around the globe, and then we've got governments, which are also known as sovereigns, and we know the problem is too much debt. We're going to take a very broad look at this. We're more concerned about concepts than specifically how money flows through the system. If you understand conceptually how money flows, you can make much, much better decisions going forward. We're going to look at healthy markets versus impaired markets, some possible outcomes, which may be termed as solutions. Why have the financial markets been so volatile, difficult, and trendless recently? We'll look at outcomes going forward and match them with possible investments. And what you'll see is these three bullets here are all interconnected. In the United States, we've got problems that are well known that speak to the mismatch between our revenue and our spending. And we all know that there's a mismatch here. How big is that mismatch? Well, our revenue that we bring in annually is roughly 16% of GDP, which means if you took the value of all goods and services produced in the economy in 1 year, multiplied it by 16%, that's basically what we take in, what our government takes in. What we spend, unfortunately, is almost twice that. It's 26% of GDP. That's a ratio of roughly 1.63 to 1. And we all know that if our household was spending 1.6 times more than what we took in, we'd have some problems. The way the government deals with this is they're constantly borrowing money. Let's take a look at spending. There's three main areas of spending. We've got non-discretionary spending, which includes things like Medicare and Social Security, which would be things that we've committed to do. And to understand this imbalance, our revenue, for the most part, is chewed up by this box here. When we go to discretionary spending, which would be other programs, and the big component of that would be defense spending, most of that is done with borrowed money. And the fact that we're doing it with borrowed money means that we also have to service debt, which means when bonds mature, we have to pay principal back when U.S. Treasuries mature. And we also have to make interest payments on those bonds as well. Shifting gears here, what is the primary way for the U.S. government or any European government to raise capital to keep this imbalance going and to keep the government running? Most of the government bonds that they sell them in an open auction that determines the interest rate. Most of those bonds are bought by large institutions that we talked about here. So they send money to the government, and the government gives them a treasury bond in return. Comes to this side. Mainly we're talking about banks and brokerage firms here. So think Bank of America, think Goldman Sachs. How do they raise capital? Well, in normal markets, they can sell stock. So cash comes in, a stock certificate goes out. They can take on deposits. And deposits speaks to a broader issue, which would be a country's balance of payments. In Germany, they export a lot of goods. So think BMWs and Mercedes leaving the country. So they've got a positive balance of payments. So that really means that money's coming into Germany from other countries, which some of it ends up in their financial system. Using the fractional reserve system, that money can actually be levered up, or they can create new money. So those deposits coming in or money coming in from other countries can be levered up. That can be used to keep this going and to buy bonds. Another way for a bank or a Wall Street firm to raise money is they can go out into the public market and sell a bond. Obviously, the health of banks and financial institutions impacts the financial markets, and it also impacts their ability to make loans to the real economy. And that's where you run into problems. You talk about a credit crunch, is when these institutions are not healthy, they have a tendency to reduce the number of loans that they make to small businesses, large businesses, anybody, which would have an impact on the broader economy. Let's move down to this corner. Where do central banks come in? Well, in recent years, as these institutions have been on shaky ground, they've become more and more dependent upon central banks. And typically what would happen is they would take some of these bonds that they've bought, so think a U.S. Treasury or an Italian bond, they post it as collateral at a central bank, and then the central bank basically gives them money created out of thin air. Where we're running into problems, and we're going to move down to this area here, is when you get a small move in interest rates, you can go from a situation that's stable to a situation that's somewhat of in a crisis relatively quickly. And let's use a couple of examples to do that. One example would be an adjustable rate mortgage, affectionately known as an ARM. If someone, let's say a middle-class, hardworking American, has an adjustable rate mortgage, as we know from the last crisis, when interest rates go up, it means when they try to service that mortgage, they make principal payments and interest payments. A small move in interest rates makes this payment go up, which means it makes their income from their family to their spending start to get out of balance. And again, as we know from the housing crisis, if interest rates tick up just a little bit on those adjustable rate mortgages, homeowners can get into trouble quickly. The second example that we've seen more recently with a government is Italy recently was paying roughly 5% when they went out to these public debt markets and did debt auctions to finance their spending. At 5%, they were fine. You weren't really reading a lot about Italy. When the interest rate that they had to pay on the new bonds that they were issuing moved up 100 basis points, which is just 1%, we went from Italy being fine to Italy being in a crisis. Why is that? It's because when you get this small move here, when you have a lot of debt, the interest payments that you have to make going out into the future basically become unsustainable. They start to get extremely large, and if you've already got a mismatch here with spending and revenue, when this interest payment starts to rise in the future, it makes this mismatch even worse. So when you get into that situation, so think Italy running into a problem when their bond payments hit 6%, then it also becomes questionable the assets on the balance sheets or the books of the banks and the financial institutions. They own those Italian bonds. And the central bank also has them as collateral on their books as well. When those assets become impaired, that can tend to create a little bit of a problem. And what is the problem? Well, the problem is it's very difficult to sell new stock when buyers are concerned about bad bonds that you have on your books. Deposits may even flee from banks or financial institutions. So more recently, think on Wall Street, MF Global had exposure to sovereign debt in Europe, and customers basically fled, which becomes a problem. When you have these bonds on your balance sheet, it's also difficult to go to the debt market and sell a Goldman Sachs bond or a Bank of America bond to raise capital. So what happens is this portion of the credit system becomes somewhat impaired. What's happened in recent years to make up for this impairment is central banks have upped their game a little bit and become more and more involved, which is obviously troublesome. One example of that recently is Europe went from doing shorter-term loans here to banks and financial institutions, and they changed the term of these loans to as long as 3 years. The market has interpreted this change to a 3-year term in two different ways. Some market participants look at it as a backdoor bazooka, and let's go through that situation first. The way a backdoor bazooka would work, it would be massive money printing. What you would get is the firms can take an Italian bond, post it as collateral, get a 3-year loan, and then in turn, they can lever that money up and use all of those funds, send it to these governments, so send it to Italy, send it to Spain, send it to Portugal, and buy more government bonds. Then in theory, you could take those government bonds and post them as collateral, and the process can repeat itself. Why is it called a backdoor bazooka? Well, if you understand the way that the EU was set up, unlike the United States, the European Central Bank is forbidden legally from printing money and funding governments. The term backdoor comes in because this is really a way, potentially, to get around that problem. This allows the central bank to print money, and the dirty work is actually done by the banks. They're the ones that buy the government bonds. There's nothing in the treaties, at least explicit, that says these central banks cannot interact with these institutions, and then the institutions buy the bonds. Under that scenario, why that becomes questionable is the problem for these financial institutions is that they're currently hampered or cut off from their typical sources of funding because market participants look at these bonds on their balance sheets and they don't like them. So under the backdoor bazooka scenario, what they're doing is increasing their exposure to these questionable debts. So short term, could the backdoor bazooka allow the euro to spike up, the dollar to go down, and the U.S. stock market to rise? Yes, it could, because short term, it does allow these banks to support future government bond auctions. And we already saw that where an auction for Spanish bonds was what's known as oversubscribed. And the theory is that the Backdoor Bazooka allowed them to do that. If you use the Backdoor Bazooka as the long-term quote-unquote solution, you're basically saying that the banks and financial institutions will be perpetually dependent upon the central banks and printed money to make this whole thing work. Why is that? Because if they increase the amount of Italian bonds and Spanish bonds on their balance sheets, they're going to be unable to issue stock. People are going to flee the institutions because they're going to have concerns about their balance sheets, and they're not going to be able to sell bonds. Now, another way to look at the recent change to 3-year terms on these loans is that the leaders are prepping for a default. They're trying to grease up the system. So let's say if, no pun intended, if Greece, the country, defaulted on their bonds in the next 60 to 90 days, these 3-year loans would allow the banking system to somewhat function while they're shut out from these markets. And if we go through a cycle of sovereign defaults where you get write-downs in Greece, write-downs in Spain, write-downs in Italy, etc., these institutions could be cut off from their normal source of funding for quite some time, which would make it nearly impossible for these governments to sell future bonds to keep this imbalance going. So you look at this one of two ways, and this is why the markets have been so jittery. If the backdoor bazooka theory is where we're going long term and the ECB is just going to indirectly print money, that means that inflation-friendly assets like stocks, gold, copper, etc., would be in favor as they try to inflate their way out of it. If they're preparing for a default, which is really the way the markets are leaning right now, those are the exact assets that you don't want to own. This is a deflationary scenario, and the investments that do well over here are the exact opposites of what do well under this scenario. What does well under a write-down or default scenario, a deflationary scenario, would be very conservative bonds, cash, and while it may sound a little ironic, it would be the safe haven US dollar. Why would central banks extend the term of these loans to 3 years? What happens here is as these institutions get impaired, obviously they tend to cut back on their lending. And let's talk a little bit more about why that is. Well, you've got a balance sheet here with assets and liabilities. The bonds that they have on the books are worth less, and the regulators are telling them that they need to raise capital. They have a tendency to hoard their cash, and then you get the credit crunch situation. And maybe more importantly, when these institutions are not healthy, it has a negative impact on the financial markets. Then, in turn, what you can get is these interest rates that you have to pay in these public auctions can go up even faster, exacerbating the problem. Then you get to a period where you've got an unsustainable situation. And why is it unsustainable? It's unsustainable because long-term the interest rate that they're paying and the interest payments that they have to make going out into the future, there's just a huge mismatch between revenue and spending. There's another reason why it would be difficult for the backdoor bazooka scenario to be a long-term solution, and let's look at that now. Under the backdoor bazooka scenario, the financial institutions take a low-interest loan. So for the sake of conversation, let's say when they post the collateral and get the money, they pay 1% annual interest on that loan. They then take that money and in return swap it for an Italian government bond, let's say, paying 7%. If I bought an asset that pays me 7% and I did it with borrowed money, but I only have to pay back 1% a year, that spread, that's my profit, which means the banks could make a 6% profit. Now, if I have a 6% profit built in, why would I ever go out and make a loan to the general public? Because that spread would be much, much smaller. And the real issue why the backdoor bazooka would be difficult to be a long-term quote-unquote solution is, how do you think the general public and taxpayers are going to feel about central banks and governments once again padding the profits of banks, which would enable them to continue this really unsustainable situation? Let's shift gears back to the real economy now. The argument in the 2008 financial crisis, early in the crisis, was that we had a problem that was based in the United States, and thus emerging markets would be insulated from it and it wouldn't impact their economy. The reality was eventually they did not decouple and the problems spread globally. So we've got a situation here currently in Europe where the longer these things go on, eventually you get out here and it impacts the broader economy. This is what a normal credit market looks like. And it's all built upon the fact, really, on trust and that these assets here are worth something and the risk is relatively low. These bonds used to be known as risk-free. Well, we all know that the government bonds are no longer risk-free. And this source of funding has been impaired or cut off in some cases, which is impacting these situations here in terms of the markets and loans. The situation has gotten so concerning in some countries, and they're afraid that this is where we're going next. Here would be a global recession, that some central banks do even more than this. And they've somewhat learned that they may have to just bypass a normal functioning credit market like this. And the way that they've done that is in the United States and in the UK, they do something known as quantitative easing. And quantitative easing really is just pure money printing. The central bank creates money out of thin air and they buy government bonds, which is really an indirect way of financing this spending that's out of whack with revenues. And in Europe and in the United States, the central banks buy these bonds in the secondary market, and you can say they're not financing the deficit directly. Well, that's really just ridiculous because they're creating demand in these bond markets. It doesn't matter whether the ECB or the Fed participates in a bond auction or a new bond offering. If they're in the market buying on the secondary market, like you would go buy a stock, they're impacting those auctions indirectly. So they don't have to participate in the auctions to impact the market. What the market would care about is that you've got that quote-unquote backstop here. The problem under this scenario where you get into pure money printing is the more money that you pump into the system, eventually you start to create inflation. And as inflation rises, it really becomes a situation where you're making your problem even worse because then the interest rates that you have to pay at these government bond auctions will increase, and as your interest rates rise, you run into a problem. So there's a point of diminishing returns and there's limitations with money printing. That's not a long-term solution. And if you study history, money printing ends badly. And why does it end badly? Because when you get to this stage, this is the last stage where the confidence in a currency breaks down, and then you really run into problems. What are some of the potential options for leaders, solutions, and we'll put solutions in quotes? You can inflate your way out of it, which we've covered, which is printing money. You can restructure your debt, which is what Greece is trying to do right now. Instead of owing 100 cents on the dollar, they're trying to owe 50 cents on the dollar. Or you can have an outright default where the bond that you have in your safe deposit box or in your account really just becomes worthless. When you see these are the options that you have, you begin to understand why the financial markets have been so volatile. These are binary outcomes. This is an inflationary outcome where inflation-friendly assets like commodities, precious metals do well, stocks to some degree, especially in the early stages. Under this scenario, you don't want to own stocks, you don't want to own copper, you don't want to own gold. So the market is jumping from they're going to try to inflate their way out of it. No, they're going to default on their debt. And that's why it's been so difficult for investors and investment managers. What that tells us is until we understand the order of operations here, we need to remain extremely flexible. One day it can look like they're going to default, and the next day it can look like they're going to try to print their way out of it. What is the market currently telling us? The market's currently telling us that they think we've got restructuring and defaults coming. Now, why is that? Well, if the market believed the leaders in Europe that no one else was going to default, the spread between the interest rate on an Italian bond and a German bond would not be as wide as it is. If you were very, very confident that there was going to be no restructuring and no defaults in Italy, then you'd load up on those bonds. They're paying roughly 7% right now. The fact that they're paying 7% tells you that the market perceives that there's risk. The other thing that the market's telling you is that spread between a German bond and an Italian bond, it tells you that the debt markets think that the euro is going to have some problems in terms of countries leaving. Otherwise, that spread would be much, much smaller. So as the market and leaders oscillate between possible inflationary outcomes and possible deflationary outcomes, it's important that we remain flexible. One of the reasons why the market does oscillate between default and inflate is what's known as press conference risk. The central bankers and government leaders can change the rules in these financial markets with one announcement. And a great example of that was the week after Thanksgiving. The week of Thanksgiving, the S&P 500 looked extremely weak. It looked like we were headed for a deflationary scenario. All technical indications were that the S&P 500 was going to retest the October lows and probably exceed them. And then the week after Thanksgiving, central bankers around the globe announced a new short-term lending facility, and the market immediately switched from the restructuring default scenario to inflate your way out. So the press conference risk in these markets will continue to remain high, and that really is the source of the volatility and the difficulty for investors. Looking at the options or quote-unquote solutions that leaders have, if you want to try to get elected or you want to continue to run your bank or you're in a position of power, a Bandaid solution is to kick the can down the road by taking on more debt and using leverage to take on even more debt, and you can keep this thing going a little bit longer. That's the scenario where leaders say, well, we need to buy time and we need to grow our way out of this. Well, it's becoming obvious with the persistent high levels of unemployment that we have and slower growth that when your debt levels get this high, it impacts growth, and it's very, very difficult to grow your way out of it. So trying to buy time by taking on more debt and using more leverage, you're just simply postponing the problem, and ultimately you're making it worse. And why are you making it worse? Because you're taking on more and more debt. That means there's going to be more to restructure or more to default on. And until we get some restructurings or defaults, the economy globally is going to be saddled in a slow growth scenario with persistently high unemployment. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Ciovacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.